All right, thank you guys for coming. It's really awesome. We have a lot of new people here today, which is pretty awesome. Hopefully this is great value to you guys, being able to learn from great entrepreneurs. First, I'd like to do a couple things. I want to thank the Eureka Building for sponsoring this event. Taylor in the back, Taylor Kirk with the Eureka Building. If you guys want a tour, a place to work, they're very supportive of the OC startup community, so they even have like free programs for a limited time if you need a place to have a meeting or anything like that. They have the Eureka Hub upstairs. If you need your own suite, they can welcome. If you're thinking about throwing an event, you can also reach out to Taylor. I'd like to also thank my co-organizer, Steve Meyer, who puts the video together. He's been awesome. Jeff over at Fugu, who's been doing this, and Deepak Shah, who unfortunately couldn't make it. He's busy washing his cat. So with that being said, I would really appreciate it. One tidbit, we are doing Entrepreneur Happy Hour over in downtown Orange today. It's really fun. We have quite a few people come out. Come join us. It's really a fun Friday night. We share about fundraising, recruiting people, and then we forget about what we said. It's really, really cool. So just make sure you take an Uber home. All right, so Erik, thank you very much for coming. Can we get a hand of applause for thanks for making it, man.
Sure,
really appreciate it. So let's start at the beginning. Before you got into entrepreneurship, do you remember what time you were born?
I do not know what time I was born.
You should text your mom. How'd you get into entrepreneurship, by the way?
Yeah, so I started out my career as a software developer and was at the time working for a large consulting firm. So that was really my first real job. And worked on a variety of projects there, everything from really big clients to working on, we actually helped some startups refine their product and take it to market. And I kind of got hooked on that. I really enjoyed working with these smaller companies, seeing the whole picture, thinking about how to position the product, take it to market, and then our firm, it was a kind of big consulting firm, Accenture, we would help them kind of push those products. These are like enterprise software products, through our channel. And this was kind of late 90s, just as the web, the graphical web, was starting to emerge as a commercial medium. So I ended up as part of the first group that Accenture formed around the internet. And at the time, big companies actually weren't doing that much with the internet. So we were working with a lot of startups and smaller companies and trying to kind of push some of the technology into bigger clients, but usually ended up working with startups and smaller clients. So that's kind of how I got hooked. And I just liked working with smaller companies and entrepreneurs much better than working with big companies.
So did I hear that correctly? You went into more of a product side?
I did. So after, when I left Accenture with actually a few colleagues from there, and we started a company called MVP.com, which probably nobody remembers because it's not around in that incarnation anymore, but it was a e-commerce business, a sporting goods e-commerce business. This is like 1998.
Great, and then what happened? How did you end up at TripAdvisor, by the way?
So TripAdvisor, I ended up there after MVP. I worked at eBay for several years, and then as eBay was growing and getting bigger, it actually started to get into a really big company. So then I left and was thinking about doing something else and ended up working at TripAdvisor, which was still pretty small at the time. It was like 30 or 40 people. So I was the first VP of product there and kind of built out a product management organization and started to launch sites in other countries and scale globally.
So working at eBay and having that experience, you probably had your pick of the litter as to where you wanted to work. Why'd you go work at TripAdvisor?
Yeah, TripAdvisor, I mean, it was a combination of things. So the founder was an incredible founder. He's still the CEO today. I mean, the company it's like a 15 billion market cap or something like that. And the same guy who started it, who's a software developer, is still the CEO today. And he's probably one of the best entrepreneurs. I mean, probably one of the best CEOs I've met, even public company CEOs. So that was part of it. I mean, he himself was a really compelling founder and colleague to work with. And the business was really interesting at the time. It was still relatively early, but it was growing really fast. And it was primarily SEO driven. And I was really interested in SEO and using SEO to drive growth in the business. The category was interesting to me too, travel. So it was a combination of all those things. But really, the team was pretty compelling.
What's like 2 things that you learned at TripAdvisor when you were there that you were like, whoa, I can take that to other startups?
Yeah. Well, I mean, I think one was that, you know, this was before the whole notion of like lean startup and, you know, product market fit. All the tactics of lean startup hadn't been popularized yet. But inside the company, and this was really driven a lot by our CEO, you know, whom I give credit for this, he had sort of intuitively figured a lot of that stuff out. So one of the things we would do all the time, which like a lot of our employees couldn't wrap their brains around, is we would launch things on the site. I mean, you know, this was at a point where we already had a fair number of users. So we would launch things on the site to see if anybody would interact with it. Like we would launch buttons that didn't do anything, that would be like a you know, error page. We would, you know, launch basically like build fake features to test them. We wouldn't even fully build them out. We would just, you know, put buttons or build new pages, new flows that didn't really have a backend, just to see what people did with them. Because it was a lot, you know, cheaper and faster and easier way to test things and validate our hypotheses around certain new features. So instead of taking months to build out like social functionality or whatever, you know, we would just test it. And that concept, you know, to people was, it was before, again, a lot of this, you know, sort of lean startup methodology, if you will, was popular. And people, like, we would debate this internally within the company, especially outside of like product and engineering. Like our marketing people were like, no, you can't do that. Users will, you know, it'll be an error page, and people just couldn't wrap their brain around it. But now, I feel like that stuff is pretty standard, where you really test things and don't build them out and do things in a scrappy way, so you're not burning a lot of resources or time on things that may just not work. So kind of lean testing and methodology in general was the first time really that I had seen that implemented at a company-wide level. You know, we always did hacks and did things when we were, you know, building products, but this was like he drove this into the company culture, which was pretty incredible, and still sort of remains that way today.
So that was before the whole lean methodology was mainstream.
I mean, years before that.
So he got a lot of freaking grief, I'm sure, that when he was doing this stuff, internally, be like, why are we working for this guy? This is crazy. Marketing people are like...
People thought it was crazy. I mean, like our customers, everybody thought it was crazy except for like the product and engineering. Even in product and engineering, there was debate about it. It was not well accepted, but I mean, this was, you know, one of the things, he's actually a brilliant entrepreneur. He kind of saw this, had the, you know, and was dead set on this, and it worked over and over and over again where we test things, and you know, some worked, some didn't. We would never burn engineering resources.
Yeah, right, yeah, a lot of resources.
And stuff we never would have built, actually. Never would have put the time in to build it. We would test it, and then it worked great, and then we would actually build it.
Awesome. So when Erik Rannala actually like released like the lean startup, did he like email company like all at TripAdvisor and go, told you, bro?
He should have.
What up now?
Well, he should have. The funny thing is when all that stuff came out, we're like, oh, okay, well, we've been doing this for a long time. So
that's so awesome. So what did you do after TripAdvisor?
So after TripAdvisor, I left TripAdvisor as it was starting to also get it quite a bit bigger. So I kind of wanted to, again, go do something smaller. So I was thinking about starting a company. And then...
where were you living when you were at TripAdvisor?
In the Bay Area. So before moving to Southern California, I spent most of my career in the Bay Area. You know, TripAdvisor has offices kind of all over the place, but you know, I spent a lot of time in the Bay Area, a lot of time in Boston, because there's a big office in Boston as well. So I left TripAdvisor and was thinking about what to do next, and was kind of mostly thinking about starting a company, and then reconnected with an old colleague from eBay, and we both left eBay around the same time, and I was mostly talking to him about starting a company, and he'd been doing he was teaching at Stanford and started doing a lot of angel investing, and you know, his angel investing had ramped up, so we were mostly brainstorming about starting a company. And then that, you know, as we were doing that, his angel investing had been escalating, and that was sort of morphing into a fund. And then as, you know, these few months passed, we, you know, instead of starting a company, it turned into, hey, well, why don't we invest this fund together? And this fund was kind of, you know, had sort of come together. So I ended up doing that almost, you know, just very serendipitously or accidentally started doing investing full time in the context of a fund. So started doing seed investing, and this was kind of 2008, 2009, late 2008, early 2009. And what we ended up doing was starting a firm called Harrison Metal, which is a seed stage venture fund in the Bay Area. At that point, seed stage or micro VC was just starting to become more prevalent. I mean, really, Harrison Metal, and there were a couple other firms, Baseline Ventures, Floodgate, had gotten started. But this was before this whole wave of kind of micro VC and seed stage venture had gotten going. My partner had kind of, started doing angel investing. His angel investing had ramped up and sort of turned into a super angel, and that morphed into a fund. And then I kind of joined him and started investing in this fund together with him.
So that was still in the Bay Area, right?
That was in the Bay Area.
What was the transition to Southern California?
So I moved down here to Southern California almost 4 years ago. And part of it was purely personal. This is, my wife grew up in Orange County, so this is where we wanted to live long term, just to be closer to family, and we like living here. And then part of it was also just kind of circumstantial or serendipitous. My partner at Mucker, also an eBay colleague, a different eBay colleague, but he had moved down to LA in 2006, also for personal reasons, but then started working with Starups here in LA. It was at a company called Green Dot and some other companies.
I saw Dave Burgess yesterday, by the way.
Okay.
Yeah.
So he was already down here, and this was the one place in the world that we would have moved outside the Bay Area. And he and I had been talking about working together again for 10 plus years since we were at eBay. The timing and location and everything hadn't really worked out, but finally it did, where he was already down here. We were kind of ready to move down here. And then what we saw in LA as an ecosystem, or more broadly in Southern California, I mean, I say LA, I kind of mean,
it's
LA
County,
metro area, which is,
Which, by the way, doesn't include San Diego. I just figured that out.
It does not, that's true. I mean, LA metro is really like LA Orange County.
Yeah.
So
we'll leave those biotech guys.
Exactly. So we saw that there was a lot of activity, a lot going on, and Will, actually having been here years before I was, saw things really starting to kind of evolve in the ecosystem, but yet there was, this was like late 2011, early 2012, there was no, accelerator program in LA. There was no institutionalized kind of seed stage venture fund, which had really started to proliferate, in the Bay Area and even in other places like New York. And even then, at that point, there were lots of accelerators everywhere, but yet in LA that hadn't really started to take off. So we looked at that and saw all this activity in the ecosystem, but yet the seed stage infrastructure, of kind of seed stage venture and pre-seed kind of accelerator stuff hadn't really started to develop, so we decided to do that.
And where does the name Mucker come from?
Yeah, that is sort of a obscure, geeky Thomas Edison reference. So Thomas Edison created the first real kind of industrial laboratory at scale in the US, and had a bunch of other guys, inventors, really work with him in this lab. And they ended up being called Edison's Muckers, because one of the things they were trying to do was invent a better formulation for bricks. This was like the late 1800s, so literally they were knee deep in mud and muck, and with hay and putting together bricks, and all these reporters. Edison had some notoriety already at that point, so all these reporters were following him around, like basically the paparazzi of like the 1800s, and took pictures of him, and it was published in newspapers, and the reporters said Edison and his muckers, in the muck, doing blah, 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 and the name stuck, the Mucker name stuck, so they started calling these guys Edison's Muckers, and they actually started self-identifying as, the Muckers, and it was like a fraternity of Muckers, and it became this thing. But really part of it is we just love that ethos of, well, Edison was all about experimentation. All he did was tinker and experiment all day long, and that's what these guys did with him. So, and it was all commercially focused or commercially minded. He wasn't a scientist. He didn't make scientific discoveries or breakthroughs. He was all focused on commercially minded sort of inventing and tinkering. Engineering, most of it was engineering based, or engineering, he had sort of an engineering mindset and focus on the things that he built or invented. He was all commercially minded, and that sort of is the ethos of, what we want to do too, is experiment, build things, mostly from a computer science perspective, not a physical kind of engineering perspective, and then create a place. We have an office where a lot of our portfolio companies work out of the office and collaborate, and much like his lab was, I think it's probably a lot different, but again, the ethos of what we're going for is that.
You know, it's kind of funny. One of the first biographies I read was Rockefeller's biography of Titan, and the second one was Inventing the Century from Thomas Edison. It's unbelievable how misunderstood and misconceived Thomas Edison is. He's the ultimate entrepreneur.
Oh, yeah.
A lot of people don't know that he had hundreds of people work with him, and he was essentially what you see now in like Silicon Valley, or you see just software technology. So if you guys haven't really delved into Thomas Edison's background, it's such a fun read, Inventing the Century. There's a lot more books like that, but
yeah,
it's incredible.
I mean, he literally had like the first incubator, you know, and would have all these other inventors, other entrepreneurs basically come in and work with him and partner with them. I mean, it was really an incredible model.
And he was a super connected guy. He would just go over to like Henry Ford's house and be like, hey, here's what I'm doing.
Yeah, I mean, and that's one of the incredible things. Like, he was, you know, wealthy, connected, and he would literally be in his lab day and night in like overalls, just tinkering, building stuff. You know, it's just what he liked doing. And that is like the prototypical kind of now Silicon Valley entrepreneur, right? You've got, one of the things that makes Silicon Valley work, I think, is that people don't make a bunch of money and then go retire and sit on the beach. There are guys who are billionaires who are still working, you know, 12-hour days and working and helping entrepreneurs. You know, like, look at like guys like Reid Hoffman, who started LinkedIn, is literally a billionaire, and he spends his weekends all day at his house meeting with entrepreneurs that he doesn't know, just because he loves doing it. You know, that is like the ethos of Silicon Valley.
I don't know if it's still true, but I don't think he drives like a nice car either. It's like an old Lincoln or something.
No, he's not like interested in that stuff. He spends almost all of his personal time, even like Sunday afternoon, Sunday mornings, like meeting with people he doesn't know, helping entrepreneurs.
I met Reid at South by Southwest, and it was uncanny how awesome of a dude he is. It's just, you wouldn't even know. If you didn't know who Reid Hoffman is, you would just think he's like this cool, really intelligent guy that just came across.
And a lot of, you know, again, I think that's part of what makes Silicon Valley work. You know, it's even though money is sort of one measure of success, it's not really the end goal. People just love doing it, love building things, love creating things.
So you're living up here in Newport Beach.
I am.
And is Will, your partner, living in Santa Monica?
He actually lives in Hollywood.
Okay.
So we both have a little bit of a commute.
Yeah.
Our office is in Santa Monica, so we both have a little bit of a commute.
Was your first office the one next to the old Mahalo office?
It is, yeah.
Oh, okay.
Yeah, we were there for about 3 years, actually.
Cool.
So we moved about 6 or 7 months ago.
So it started off as an accelerator, right? And then you have a capital, and then it's kind of, I mean, some people don't know if you still do the accelerator or not, so tell us a little bit about that.
Yeah, we do both, and almost from the beginning I've done both. So we make seed stage investments, or what I'd say are kind of classic seed rounds now, that are in the 1 to 2 million range, or sometimes the rounds are smaller. And then our investments are anywhere from kind of a couple $100,000 up to 700 or 800,000, depending on the size of the round and how mature the company is. And then we also make pre-seed investments. Basically, we run what is ostensibly an accelerator called Mucker Lab. And those are companies that aren't quite ready to raise a seed round. They've mostly raised angel capital, or they raised angel capital like concurrently with our investment. And then what we do is structured very much just like, you know, an accelerator structure. Our investments are usually kind of 5-figure investments for a set percentage of equity. And then those companies work with us over the period of a year plus. We don't run kind of a 3-month boot camp type accelerator. We work with a very small number of companies every year, maybe 10-ish companies a year. And then a lot of them work out of our office, and we'll work with them. Really, it's not time bound, it's more milestone based. So we'll work with them from wherever they are until they get to a place where they're positioned to raise a seed or Series A round of funding.
You know, are you familiar with the K5 guys?
Yep.
So they have a similar model to that. It's interesting, but they're here in Orange County.
Yep.
Yeah, it's been really cool actually. You can't really get it all done in 3 months.
It's
really, you want the traction, but at the same time, some things take time.
Yeah, it takes time. I mean, I think that, you know, I think both models can work. Sort of the 3-month, more like a boot camp model, and then, you know, the longer period of time. We just felt like we wanted to work with a smaller number of companies over a longer extended period of time and really dig in, versus, you know, what like YC and increasingly Techstars are doing, which is expanding, investing in a lot more companies, YC's invested in well over 1,000 companies at this point.
So let's talk about, so you guys came to Southern California right before the whole Silicon Beach really started to proliferate.
Yeah.
And now you've seen that ecosystem. Can you tell me about what attracted you guys to that ecosystem and what you saw that worked there? We've seen, a lot more tech companies here in Orange County, and we sort of like to learn. I mean, you being based in Orange County, what you see there, what you think work, and the type of companies that you like to focus on.
Yeah. I mean, we ended up being based there just because I think as things started to, percolate, there was a density of activity, on the west side around Santa Monica, Venice, really from kind of Santa Monica down to maybe El Segundo, Culver City, there's stuff going on. And then a lot of bigger companies have, were then and are still now kind of building out around that area. So Google just bought like 15 acres on the west side of LA, and it's still for like a couple of million square feet. So they're building out a huge facility there. So there's a lot of concentration and density happening there. I think the perception outside of LA or outside of Southern California is that LA in general is just all like Hollywood and media stuff, and then the LA tech ecosystem is a lot of just like digital media, whatever that means, and or maybe advertising or something like that, which there is plenty of, but we see an incredible diversity of stuff. I mean, we've invested in, we do look broadly across enterprise and consumer technologies, almost exclusively in software and internet stuff, but we've seen and have invested in everything from, security software, fraud detection, developer platforms.
Did you say fraud detection?
Fraud detection.
Fraud detection.
Yeah, fraud. Yeah. Not fraud. Fraud.
I'm sure you've seen the commercial. If not, I'm sure.
I actually haven't. I don't watch a lot of TV, so.
I don't either, but you see it. My girlfriend in the morning, she loves to wake me up watching these shows on Hulu, and that's commercial plays over and over and over again.
Really? What commercial is it?
It's like some Discover. It's Discover credit cards, right? Anyway, these hippies don't know.
Yeah, sorry, I don't watch a lot of
Whatever.
TV.
Yeah, sorry. I bombed. It's okay. It's not the first time.
It's okay.
So you're saying fraud detection?
Yeah, fraud, security, really sort of not consumer stuff, very enterprise focused. Enterprise SaaS we've done a bunch of. And then, we do consumer stuff on the other end of the spectrum, and then everything in between. So
you guys invested in a plane company or
we did,
like Uber for private travel?
It's a membership-based subscription airline. Yeah, so like a semi-private airline, which is actually doing great. I mean, it's the same principle in terms of like shared economy. There are all these small airports scattered all over the place that are, completely underutilized. A lot of them barely see any planes all day long. And they're using small airports and then small aircraft. So taking really a private aviation experience and bringing it down to more of a mass market price. Right now, private aviation is out of reach for like almost everyone on the planet, right? It's like $40,000 to fly to San Francisco. If you do like a NetJets or something like that. But what these guys do is they run basically routes, scheduled routes all day long, like a bus or a train. And if you remember, you can jump on any one of those flights. You can get on any flight and fly unlimited on the routes that they fly. And it's roughly, $1,500 to $2,000 a month for a membership.
So
for people
that's
that go,
just a great price.
Yeah, for people that travel like every week, for example, between LA and the Bay Area, something like that, it's actually it's almost a wash, right? Because if you're in Southwest, especially if you do last minute, you're paying at least $300.
Yep.
So cost-wise, it's not even that different. But you save a ton of time. You don't have to go through like TSA, no security. You use the private aviation infrastructure, so you literally like drive up, get out of your car, jump on the plane.
And that's Surf Air, right?
Surf
Just to
Air,
make sure
yeah.
we give them credit.
Yep.
The company's awesome. Tell us what do you look for? What do you look for in a company when your guys are considering to either invest in them or your accelerator?
Yeah, it's a tough question. I mean, because every company is so different, but I think there are some things that are pretty standardized. One is that for us, as a venture fund, there's certain economics or math that just have to work. So the companies or the opportunities that companies are pursuing have to be very large market opportunities, and that's just because most venture funds are structured this way, where venture funds typically end up owning a minority share of a company, So owning a small piece of a company, that company has to get very big, right? It has to have an exit that's pretty big for the math to work out, for us to then be able to return a multiple of our fund. So just the way that math works out, most venture funds are focused on what they would say are very large addressable markets, so multi-billion-dollar kind of market opportunities.
Yeah.
Not that those companies are mostly ever going to get to multiple billions of dollars in revenue or capture that whole market, but the market has to be pretty big to have a high probability of getting to some meaningful amount of revenue, which would make the company then worth a large amount of money that would be able to put a dent in the returns that we have to return to our investors in the fund. So
what's usually the bottom threshold? Like, is $1 billion a big enough market? Is $7 billion a big enough market? What's usually, because I definitely get it. I mean, I have a startup, we're funded, we've been there before, and usually, you know that company's not capture the whole market, so it has to be a very, very big market where some people will buy and you still become a very big company.
Yeah. I mean, I think this number sort of varies for different people, but I'd say the minimum is typically $1 billion sort of addressable market opportunity.
Okay, that's good enough.
Yeah. I mean, I'd say that's usually the rule of thumb. People are looking for at least $1 billion. And this is venture funds, by the way. So like angel investors all have their own kind of rules on this.
Yeah.
And I guess I would clarify too that just because a company isn't addressing like $1 billion market opportunity doesn't mean it's not going to be a great business. There are tons of companies that aren't going after those types of market opportunities, et cetera, that can be awesome businesses and make the founders extraordinarily wealthy and make their angel investors like a nice multiple on their investment. So I think sometimes there's a misinterpretation that means, oh, it's not a good business. It's totally not the case. It's just that there are some types of businesses that could be really good businesses that aren't a fit for venture capital.
What about, what else do you guys look for, besides addressable market being big?
Yeah, I mean, the team is always, and everybody says this, so I think that, I think the team is always a big factor. And that one is, everyone says team, and I think everyone looks at team a little bit differently, or the things that they're looking for are different, or the way they evaluate teams, is different, but that certainly is a big deal for us. I mean, there are some things that are, again, almost standard, I'd say, like whether investors tell you or not, if the team isn't working full time on an idea, it's going to be really hard to raise funding. So everyone has to be not only full time, but clearly committed, right? That they're not doing this for as long as it's fun or easy, but that they're going to kind of grind through this. And that's something that everyone's going to say, but we look for indications that that's true. And that could be that, people have worked on startups before, so they know what they're getting into, because it's really hard. Or they, have built or done things that are very unlikely, or took tons and tons of commitment and time and work, and they didn't give up on them. So part of it is just like almost like a personality thing. Honestly, we have to believe that when things get really hard, that they're not just going to kind of fold up and go get a job, right? That they're going to push through it, because invariably it's up and down. It's kind of a roller coaster. It gets really hard. It's really easy to say like, oh, this sucks, I'm just going to get a job, right?
Yeah.
So that doesn't work most of the time, right? Because if everybody, when it gets hard, picks up and goes to get the job, then our whole portfolio dries up. So we have to believe that they're committed and that they're going to push through it and that they're going to grind through it, and just like the knife in the teeth kind of run through brick walls to get there. So that's an intangible that we just have to believe, and that comes in many ways, I think. But
so let's say you tick off those two check boxes. So we got addressable market, we have team.
Yeah.
Right. But let's say the team has good pedigree, right? But what are some of the qualities in the entrepreneurs and the founders you just go, F no, we are not funding this guy, or these guys or girls, like this is not going to work. I don't think they're, you always talk about coachable being one thing, but what are some of the signals for you because you've been there, you've been an entrepreneur. So what are some of the signals you're like, I want to freaking hire that guy to work for me?
Yeah, I mean, the funny thing is, you mentioned coachable and like, would you hire that guy? That's almost even a tricky thing, right? Because it's a fine line, I think, with entrepreneurs where if they're too coachable or too, susceptible to just taking advice without having really strong convictions, that's almost a bad thing, right? There's this, it's like threading a needle between, you know, knowing when you're getting good advice and taking it versus just like letting, you know, kind of flopping in the wind, right? And so I think we love it when people have conviction and are sort of dead set on what they're doing, but yet still can have like a reasonable conversation and know good advice when they get it, right? You know, then there's, you know, the far end of the spectrum where people literally are like allergic to good advice, right? And can't make the same mistakes over and over again. That's bad, right? Or there's
My dog is super allergic to great advice, by the way. Never listens to me. Sit.
It happens. But some people, you know, that's bad, right? So people that won't listen, won't take any advice. And then the other end of the spectrum where people can't, you know, they take in everything and can't make a decision and have, you know, have a hard time finding conviction or sticking to some conviction. So that's almost, you know, threading this needle. And we almost would veer more toward people who are a little more stubborn, you know, because again, I think sometimes you just need to plow through with your conviction, because a lot of times, you know, a lot of investors and entrepreneurs will say this, but it's true. A lot of times some of the ideas that end up being big ideas are ones where people think it's crazy, or they won't invest in the beginning, or, you know, it seems like it's going to be crazy, but you have to kind of push through, especially when things get tough, and not just take do what everybody's telling you to do. And that's part of the entrepreneur personality in general, right? They're bad employees. Most entrepreneurs aren't the best employees because they have strong opinions, and, you know, some stupid boss tells them to do something the wrong way, and they're like, well, that's stupid, I don't want to do it that way. Most of the time, like, bosses don't like that, right? So, but they're probably right. But, you know, that's just the way. That's kind of the personality, right?
Yeah.
And that's a good thing for entrepreneurs, bad thing for employees, or not, you know, not terrible, but it takes a different kind of boss to manage employees or want employees like that. I think net it's better, but usually in a lot of organizations, people just want, you know, to do it, follow orders, basically, right? And that's usually not the entrepreneur profile.
So when you guys are looking at like a startup, let's say accelerator stage or seed stage, one question that always comes up that I hear a lot from founders, and I work with a lot of them. I'm very careful of my time, so usually we have some complimentary stuff, and we do a lot of stuff for the community here. But one of the questions is, okay, I'm going to raise a round of funding, and you meet some entrepreneurs going, well, okay, cool, yeah, but that's like $150,000 salary, and you're just like, what? Really? You raise $200,000, you're taking that, or you raise $500,000, you're taking that.
Yeah. So
what are some of the red flags when it comes to a founder? Do they get paid? Do they not get paid? Do they work for free even those who raise funding? What are usually the thresholds?
Yeah, I mean, I think it depends on how much they've raised, what stage the company is at, you know, what their own personal financial situation is. And sometimes it's a hard conversation. You can't really dig into exactly the financial, but you can get a sense for it. I mean, I think our thinking there is it has to be sort of within reason, right? If you raise $200,000 and you want to take $150,000 salary, that's pretty clearly, you know, not going to be okay. If you've raised, you know, $3 million and you're taking, you know, $150,000 salary, okay, like, let's talk about it. If you've got like 3 kids and a mortgage, you know, like, I think it really is a negotiation, like everything, or like a lot of things in life.
But let's say they have no kids, right?
Yeah.
Or
I mean, if they're like single, no kids, and they want to take like a big salary and haven't raised that much money, yeah, that's not.
But what would you say for like a new up-and-coming entrepreneur? They don't have a mortgage, they don't do anything like that. There is no financial situation, seed stage type company, a company you want to invest in, but what's usually a red flag? Or where do you think I'm trying to educate the audience a little bit. But there are sort of rules of thumb that...
We don't have a specific number, to be honest, but I guess the attitude we like and we see a lot is entrepreneurs only take as much as they need. We talk about what their personal burn rate is, and then we look at their personal burn rate, and then we talk about what they're going to take in terms of the salary, and we work it out like that.
Yep.
And then, you know, if their personal burn rate is really high, then we have a conversation about their personal burn rate, and, you know, whether that's compatible with what they want to be doing as an entrepreneur.
I've seen a lot of entrepreneurs take between 60 to like 80, 85, depending on their situation.
Yeah.
Have you seen the same?
Yeah, I think that's reasonable. We've seen a lot of entrepreneurs take less than that. because they've got they've intentionally, made sure they have a really low personal burn rate, and they want to hire another engineer instead of, having a nicer car.
And that's an awesome entrepreneur, by the way.
I mean, we love that,
Yeah.
but we see a lot of people do that, honestly, because, if they can pay themselves half as much and hire another engineer, who's committed and wants to work for, high equity, low salary, that can literally, make or break their company. And the ones that understand that and do that math, I mean, I think that's great. Now, we also understand not everyone can take no salary, right? But usually the conversation is like in the context of what's your personal burn rate? Does that personal burn rate make sense, right? And then what does that translate into as like a fair salary? Because in general, this might sound like, kind of callous or controversial, but like people should, I don't think people should be taking money from investors and like putting it in their savings, right? They should be paying their expenses and using the rest of that money, anything that's not paying for their living expenses. Yeah, you need to like go out to dinner or whatever, but you shouldn't be like saving using your investor money. That should be going to the company and paying other people's salaries to do work for the company, build the company. Eventually you're going to save, but eventually what you're betting on as an entrepreneur is you're betting on, generating wealth later on down the line via equity, right? Not taking your salary and banking it. If you want to do that, get a job.
Or buy McDonald's.
Yeah, anything, right? Do something, but it's not really compatible with raising money from investors and then taking that investors' money and like putting it, in their 401k.
Makes sense. I mean, you just want to put everything into the company to
Put it in the company, yeah.
So what I like to do is we have time for 4 questions. Try to make them brief, please. And please go ahead and ask Erik what's on your mind. Jack, do me a favor. Please introduce yourself, first name, last name, your company, and then can you repeat the question so we can get it on?
Sure. Yep.
Jack Weiser from Security. I'm following Mucker Lab with a family of you guys, by the way.
Thank you.
I was shocked to hear you're in Newport Beach. That's great news. We've got a lot of entrepreneurs in Orange County, but the Santa Monica product isn't quite everybody's liking. Have you guys thought of doing something in Orange County?
Yeah, so the question is, have we thought about doing something in Orange County because the commute sucks? Correctly?
Actually, to answer your question, I've been hiding him in my basement for the past 2 years.
That's right. Me, my wife, and my 3 kids are hiding in his basement. Yeah.
By the way, it looks great. You guys decorated fantastic.
So, honestly, we haven't, thought about opening up anything or really, having a facility or anything down here or an office. I try to spend, maybe like a day a week or so down here, depending on my schedule and if I can. Partially to avoid the commute, but partially to get more plugged into what's going on here in Orange County and meeting people like you guys. I would love to get more plugged into, what's going on with entrepreneurs and kind of the startup community here, because I feel like while it's all sort of the LA metro area, it is a little bit of a separate pocket of activity, the same way that the west side of LA has a pocket of activity, and there's a pocket of companies downtown, and there's a pocket of stuff going on in Pasadena, and I feel like down here is sort of its own pocket of stuff. So while we haven't thought about opening an office, I am trying to, as time goes on, spend more and more time down here and get to know more people. So.
Hi, Billy goes from Urban Heights. What advice would you give to female founders to make themselves a little bit more, I don't want to say comfortable, but when Harvard did a study of female founders and male founders reading the same business plan, founders were more inclined to give money to the male counterparts. So specifically for female founders to kind of make it in the business and break the barrier, so to speak, what advice would you give?
Yeah, so the question was advice for female founders in particular. That's a tough one. I mean, we have a lot of female founders in our portfolio, and it's always kind of funny to me because I understand that it is harder, and I know that a lot of the data and there are a lot of statistics about the number of women in venture capital, number of women founders, number of so I know all the stats, but at the same time, for us, we actually we have a lot of women founders in our portfolio. Some of them are like the best founders in our portfolio. We've never had this thing where we look at them differently or have a different opinion about women founders versus male founders. And sometimes, depending on the type of business and their backgrounds, they're a much better fit for it. And sometimes men are a better fit for a different type of business. So we try to look at each situation individually and not really judge, oh, it's a female founder versus a male founder. I think the advice I would give, honestly, is there are a bunch of groups, like there's a group of female founders in LA that have all been getting together, sharing, helping each other, sharing kind of like contacts, and really sort of banding together. I think that has worked pretty well, and I think, we've seen even from female founders in our portfolio, they've introduced us to a bunch of other female founders, so I think stuff like that has worked pretty well. But for us in particular, like, I totally understand the question, but I almost don't know how to answer it, because for us, like, we don't see any difference. You know what I mean? Like, I would hope we never treat female founders any differently than male founders, or that we judge them or their businesses any differently. We're always trying to just look at the founding team, their backgrounds, qualifications, and the fit that they have for the business. So I don't know if that was a good answer.
I like that. I like it.
A quick question. How do you prefer to find opportunities to invest in? Like, is it through referral, or are you like, no, just anybody who thinks they've got something valuable we want to hear, we'll decide?
It's mostly the latter. It's not a requirement, but we don't really judge differently whether we know someone or don't know someone or where it's coming from. The practical side of that is I think there is breaking through the clutter a little bit helps if you do get an introduction. And I think we try not to judge like, oh, we knew this person, so we're going to take them more seriously versus like we didn't know this person. But I think it does, just from a practical perspective, help to break through the clutter, to get an introduction, or if you have an advocate, right? So like if someone I know and trust and respect emails me and says, this dude's awesome, you gotta meet this guy, that endorsement does help, right? I don't think ultimately hopefully we won't judge the business any differently once we really dig in and meet them, dig into the business, but I think it does help in terms of sort of breaking through the clutter, and always a good reference or a good endorsement does help, because even when we meet founders that when we don't know, we're still going to reference them and see what people have to say about them. So if it comes in on the front end of someone saying, hey, this guy's amazing, you got to meet this guy, it does help. But we're not in the camp where some investors are, where they won't even, they basically won't consider stuff unless it's a referral. That, we don't believe in that, but it does, in a practical sense, help.
Last question, by the way.
Hi, my name is Patel. I'm with a startup at early stage. My question is, what advice would you give to startup founders that are raising angel funding in terms of what to look for in an investor partner?
Yeah, the question is what to look for in an investor. So I would certainly, in a perfect world, I would say that investor should be able to add some value just beyond cash. Now, in reality, sometimes cash itself is just a really important thing, right? It's basically like oxygen. So cash is important, but in a perfect world, they should be adding value, should have some value add beyond just their money. But I think the most important thing I would say is, the same way that investors reference you or reference check you, you should reference check those investors. When we give any company a term sheet or offer an investment to them, we give them a list of every founder in our portfolio, their email address, and encourage them to talk to other founders in our portfolio. Most investors don't do that. I think they should in general, but I think you really have to check references on your investors, especially individual angel investors. If they don't have as much of like a reputation, because I think the reality is there are all kinds of investors out there, good and bad, and having bad investors or having a poorly structured deal where there's where there can be sort of little landmines, or not so little landmines in the structure that could really, really mess with your business. So I would definitely reference check those investors, and then if you're taking an investment from someone, I would definitely have a lawyer who understands like venture transactions or startup transactions, review in detail the terms of that deal, because I think there are lots of little things that can be kind of hiding in a convertible note or in the structure of any kind of deal that could be really, really like catastrophically bad for your company. So
one thing that we should all remember too is that just like we raise funding for our companies, you guys raise money for your funds as well.
Right.
So I mean, what are some of the things that you look for when somebody's like expressing interest in putting money in your fund?
Yeah. So we focus a lot on kind of who our investors are, and for us, it's a little different. We focus mostly on kind of big institutional investors. So these are the types of investors who invest in fund managers. So like foundations, endowments, fund of funds, like to some extent like pension funds, things like that, and some very large kind of family funds or family offices. But what we look for are investors who have a long tenure of investing in venture capital, because it's a very particular type of asset that's very illiquid. It takes a long time to realize returns, and it's cyclical, right? So what happens in venture capital as like an asset class is it goes up, interest in it goes up and down, and really the cycle is this: it's there's lots of money pouring into venture capital. So what happens when it's overfunded? Anything is overfunded, returns start to regress toward the mean, right, or go down. So returns get bad. Then returns get bad, and everyone pulls their money out because returns are bad. And then there's less money than there should be, or there's a shortage in effect of venture capital, and then returns get good because there's that shortage of venture capital leads to returns going up. And then people pour money back in, and then there's more money in it, and returns go down. And then that's the cycle, right? Returns go up, and people pour money in, returns go down. Anyway, so what we want are people who aren't sort of playing into that cyclicality, people who invest across, the long term, and they're long-term investors in venture capital. Because what all those guys know, all the fund managers that have been investing in venture capital for 20, 30, 40 years, is you have to invest in every vintage across all these cyclicality, across all the cyclicality. That's how you generate returns in venture capital. What we don't want are people that, when the market gets bad, they pull out, and then, we don't have any money, and they get all nervous, and then, the market gets hot again, and they pour back in, right? And I think the same goes for your investors. You don't want, people who are kind of, startup tourists, right? Who, when the market's hot, they dive in, and then the market, cools off a little bit, like it did in 2008, 2009, and then they get scared and like pull back and get all nervous, and they ask for their money back or whatever. That is what you don't want in a perfect world. So,
startup tourists. I'm going to tweet that and make it a definition. Urban Dictionary by Erik Rannala.
Yeah.
Well, Erik, thank you very much for your time. I really appreciate it.